Call the meeting to order. So welcome, everyone. Mike,
Hey,
start
good
off
morning.
the introductions.
Good morning, Mike Burke, CFO.
Paul Dumars, committee member.
Michael Conner, committee member.
George Elmore, committee member.
Bill McDaniel, committee member, acting chair,
Vice Chair taking on the role of Chair
vice chair,
today.
right, chair and vice.
There you go. Leanne Evans, School District Treasurer.
Brenda Giampetti, Treasury.
Barbara McQuinn, School Board Member, District 1.
Blair Littlejohn from the General Counsel's Office.
Matt Williams, Bank of America Merrill Lynch.
Anna O'Hanian, Speaker, Meredith Hargrove, Raymond James.
Thank you. Thank you. Might take a look at the agenda. Any suggested changes? So there being no,
Move approval.
Second.
all in favor?
Aye.
Aye. So the agenda's approved. The minutes, we'll have to depend on Paul and Michael if they have any corrections to the minutes, since George and I were not present. There being no objection, we will call the minutes approved. Anyone here to make a public comment this morning? There being none, we move forward. Let's see. I haven't skipped anything, right?
Nope, you're
All
good.
right, I'm doing good so far. All right, so we got some discussion on equipment leases 2019. Who's our expert on that
That would be
subject?
me today. I'm going
Please.
to take care of it. So good morning, everybody, and thank you all for coming. And I know it was a little busy in the lobby. School starts on Monday, so everybody's running at full speed right now to make sure everything's ready when the kids arrive. What we're talking about today is a proposed equipment lease, and we have done several of these. In 2014, we did one to buy buses, and at the time I thought we'd only be doing one lease, and then it became clear this is going to become something that we use going forward. So in 2015, we did a master lease, which reduces the cost on all the subsequent leases. So at this point, we're just adding schedules onto the master lease. We did it twice in 2015 to buy school buses and to put in chillers at 18 schools, once in 2016 for 60 school buses, and then we did it once in 2018, just last year, about the same time, to do chillers at 25 schools. All of them have a 5-year maturity. So we've actually, one of them, I'm going to skip a slide and bring this slide up. One's fully matured already. We've paid it off. So this is what's remaining on the leases that are outstanding. There's about $17.8 million, and a little bit rolls off. Some rolls off in 2020 and then 21. And this is the most recent one, 2023. So what we propose doing for this one, and we will have one more next year, the focus is on replacing chillers. And I know at your home you have a air conditioning unit that sits outside. Ours are so large they're in buildings. So if you're curious and right around the back of our building, there's a separate building back there. It houses 3 chillers. So they're very large. They're very expensive. So we're going to be replacing that. That is a big initiative for the school district. And fortunately, we don't have enough money to pay for them up front, so we're spreading them out over a 5-year window.
Leanne, just a quick question. The new chillers are replacing ones that are 20, 30 years old?
They're not lasting 20 or 30 years old.
Okay.
They're lasting closer to 10, 15.
Is the, what do you call it, the ER much better in them? Energy?
It's interesting, and I only know this because I spend a lot of time with the facilities team. When we did the last sales tax, we built a whole bunch of schools. We put all energy efficient air conditioners in those. They don't last as long because they're constantly on and off. Mm-hmm. Those are wearing out faster. So we're actually going, I need to verify this. I think we've gone to, we're still using energy efficient, but not the high efficiencies that are constantly on and off because those just don't last as long. Mm-hmm. So we had planned for them to last 20 years. And we had it budgeted in our capital plan to replace them on that schedule. They're failing much faster, which is why we're needing to use these leases. Because it's chillers that were not even included in the sales tax.
Do you use the ICE system or not?
No.
Okay.
We did those when we were doing the LEED certification. We did that at Pine Jog and Galaxy. But when the state came back and requires the cost per student station that we have to live within those, we can't afford to build those systems anymore. Even though they're highly efficient, and they probably will last a really long time, we can't afford to buy them anymore.
At the end of 5 years, does the ownership of the asset go from the
Yes.
lessor to the school?
Yes, actually, the ownership transfers to us right away. They don't want to own them. They want it to be on our books. It's not a lease like a car lease. It's a lease more like what we have with the cops as a master lease program. So it's really a loan, but we're required to call it a lease. But we take ownership immediately. As we spend the money, we send copies of the invoices up, and we're reimbursed from the bank. They send the money back to us. So this will also be set up with a 5-year lease, a par not to exceed $15 million. It replaces chillers at 24 schools. Again, this is the ones outstanding. Here's the new one. I have this amount at 3%. I think it's actually going to be less than that. My contact at Bank of America is evidently out, and PFM said use 3 and it's going to be too high. They're not sure the market is, and we're going to do a market update last, because I think that's actually going to take the most time today. The market is just, it doesn't even make sense. I'm not even going to try to make sense of it. I think if we did a 5-year loan today, it'd probably be closer to 1.5, something like that, maybe 2. So I think it will be less than that, but I always like to put a higher number in there, and then I'm happy to report back to you what the real rate is. I mean, when I set this up originally and started working on it, I was using 3.5, and already we've dropped it to 3, and I think it will be lower. So that's really all the information on this. It's not very complex, but I do need to answer any questions you have, and then we'll need a vote.
So moved.
Second.
More discussion? All in favor?
Aye.
Everyone voted yes, so there's no point in saying any opposed.
Okay.
Thank
So
you.
that passes.
And this is going to the board on August 21st. So, Mrs. McQuinn, you'll see this pop up on your agenda. So the next thing, we're going to go through the quarterly investment reports and normally do the market update first. We're going to do the investment reports first because they're through June 30 and the market still looked somewhat normal June 30th. So we're going to do the reports first and then go back and talk about what's going on in the marketplace. So I'm going to hand this, you got the clicker, if that works. And if it doesn't, I'll help you.
Is there an option to go full screen on there? That might make the clicker easier.
Yep, that does it.
Okay, perfect. Well, good morning, everyone. Apologies, I missed roll call, but I'm Jason Heumann from PFM Asset Management. As Leanne mentioned, we'll jump ahead to the actual portfolio, and then we can go back and look at the market afterwards. So if we dive right in here to the core portfolio, this one is as of June 30th. It's the one with $43.8 million in market value. This is the very high credit quality long-term portfolio that we manage on an active basis. You can see looking at the pie chart on the left, it's very high credit quality, and it's also diversified looking at the pie chart on the right, about half in treasuries, the other half split between corporate securities and agencies. On the left-hand side, you'll see the yield at cost number for the quarter, so earning 2.25% in yield for the quarter. You'll see a duration of about 1.47 years, so a year and a half duration. That's slightly shorter than the benchmark is at 1.81 years. We're looking to get closer to that benchmark duration going forward. On the bottom, maturity distribution, you can see that all but a slight sliver of the portfolio is inside 3 years, so very short, very high quality, very liquid. In the instance that you did need to pull money from this account, it would be available for you. Okay. Next page is where we look at the total return for the various time periods. So your portfolio is on the top there, and the benchmark you're compared to, the 1 to 3 year U.S. Treasury Index on the bottom there. You can see a slight underperformance for the current quarter at a total return basis, 1.28% versus 1.44%. Majority of that came from the being short duration. Interest rates fell during the quarter. Short duration portfolios were harmed in that, so you can see a slight underperformance there. 1 year number basically in line with the benchmark, 3, 5, 10, and since inception all outperforming. Next pages here, these are the previous 4 quarters as well as the returns. There you go, Leanne, that one there, on a net of fees basis as well. So we always put 3 performance slides in, essentially all saying the same thing, just looking a little different. Okay. Accounting page here, started the quarter with $44.2 million. We did some buys and sells. We had a change in value, so that's both the realized and unrealized gain for this quarter in the portfolio. Ending market value $43.5 million, plus the interest earned of $210,000. So when you combine the interest earned and the change in value, you have your total portfolio earnings on a market value basis of $552,000 for the quarter. Here's the sector allocation. What have we done as far as sector-wise in the portfolio? You can see kind of the largest shift there. As some of the agencies matured, we reinvested those in corporate securities. No major changes as far as allocation goes. We're really driving return as far as security selection in the portfolio. All right. Maturity and distribution. Maturity and duration distribution are the next 2 slides. This just shows where you stack up against the benchmark. We don't typically spend too much time on these 2 slides, but it does show you how you compare against the benchmark as far as maturity and duration. Okay, this is just a bigger picture of that credit quality slide on the first page. Just shows you your credit quality ratings from from largest to smallest. Let me jump ahead here. We'll look at some of the buy trades we did during the quarter. So here's some of the buy trades. You can see some of the names we're purchasing in the corporate sector: Visa, Caterpillar, Citigroup, Wells Fargo. You'll see those yields are still quite strong, mid-2s or so, 2.4 to 2.52 on the yield side. The next few pages are interest, and then we had a couple maturities. You can see here I mentioned that we went from agencies into corporates. You can see these 2 agencies matured, and a majority of our purchases were in the corporate space. Okay. The next few pages are all transactions sorted by date instead of type, so we'll fly through those here. We have all of our security detail here. And let's move to the short-term portfolio. This is where a bulk of the cash is. We're starting to spend down more of the short-term portfolio as we get later in the year. So this market value at June 30 was $334.6 million. Yield at cost here, 2.36%. This one's mixed between treasuries and commercial paper. Very short in duration because this is used to match up against your expenditures. So everything's inside a year, obviously, for the short-term portfolio. Here's the accounting page on that. Started out with $666 million in the quarter. Obviously had quite a few expenses to pay out. So we had the increase in value, and we're down to $334.6 million in the short-term portfolio at the end of the quarter. All right. Sector allocation here. So just treasuries, commercial paper. The agencies have matured off. That money was spent, so we did not reinvest those in agencies during the quarter. Let's see here. Okay, and finally on the portfolio side, we have the asset allocation chart where we take your investment policy, hard-coded into our model, limits represented by the yellow lines there, blue bars representing how much of each sector within your policy you're currently utilizing. Happy to report, as always, you are in compliance with all sectors of your investment policy. The following pages also confirm that you are in compliance on an individual security basis. Not only do you have sector limits, but you also have individual security limits. All of those securities are well within policy limits. Okay. And Leanne, you're going to do the short term?
Yep, I can use
Okay.
this one. Let's see.
Any questions before we move out of the longer term portfolios? Okay.
Yeah, we've spent a lot of time, and I wish Laretha McIntyre from my office was here. We spent a lot of time working on this report and added some extra information into this. And we have some more changes. Every time I look at it, I find things I want to improve with it. So one of the things that we've done is add a chart, and I'm going to see if I can make it a little bigger, to show interest earnings. This is just general fund because it makes it easier to compare year over year, to show what's happened with interest earnings 2017, 2018, and 2019. A lot of that is just due to changes in interest rate. Some of it is also due to the way we're managing cash, and I'll be able to show you a chart to illustrate that a little bit better later on. We've also added in the past, we had the short-term portfolio, which is what PFM manages, but it's really just the part PFM managed. And what I wanted to do was show the entire short-term portfolio, which includes bank balances, money in pools, money market accounts, all the different investments that we have. So we spent a tremendous amount of time trying to figure out how best to do that with the system that we have. And it looks a little strange when we get into the report, so I want to make sure I point that out. But we are able to show a total yield on the short-term portfolio now. It was at 2.65 versus the benchmark of 2.43. So we exceeded the benchmark there. This is the portion that's managed. This is the core portfolio that PFM has. It's really an anomaly because the short-term rates are higher than the longer-term rates. So one of the things that we're looking at is the size of that core portfolio. We brought it down a few years ago. We should be moving it back to somewhere close to 80 million, so more money is invested longer. But the longer-term rates are less than the shorter-term rates. So even though theoretically that's the best way to do it, I'm struggling with whether or not and when to shift that out, because while that's the best thing to do normally, I don't want to forego interest earnings. So we're working with PFM and figuring out the best time to do that. At some point, we're going to start shifting things from the short term into that core and hopefully take advantage of some better rates with longer term investments. But right now, longer term has a lower return than short term. So we'll take our time in doing that. So this is just going through total portfolios, 1.1 billion. It's broken out 45% securities, 41% money markets, and it's mostly pools, and only about 14% in bank balances. That's a big change from last year. So I'll show you a chart that illustrates that. This is what Jason already talked about with the core portfolio. Overall interest earnings for the general fund, 9.9 million versus 5.3 million last year. I started to pull up the entire, and we may shift to that next year and show just total interest earnings. But we have a lot of money in sales tax right now that we won't always have. We didn't have it in the past. We're not necessarily going to have it in the future. So the total interest earnings, if you compare year over year, is going to be skewed by just the fact that the balances we're investing are different. So I may keep it at just general funds so that we can do a good comparison of year over year. We've collected all the tax revenues at this point, so that's all looking good. This is let me see if I can take this back. This is showing how it's spread out, the maturity, the composition, and this is the debt portfolio. It's very high right now because in June we have to make the debt service, we send the money up for the debt service payments that are due August 1st. So it sits with Bank of New York for about a month. So when you look at June 30th, that number looks really high. It drops back down to a much lower number already. And asset allocation, this is very similar to what Jason showed you. It's just showing the entire portfolio and how it's invested. Now, this is the chart that I've shown you this before, but this is now showing the fiscal year. So it starts July 1, and I ran it through to November 30th. If you look at last July, the green is bank balances. So it was mostly in bank balances until we got to December and January when tax revenues came in. When you look at this July, we have a lot more invested, and we have a much smaller amount. This white line is 2 weeks' worth of expenditures. So we're trying to keep the bank balances down to about 2 weeks. The spikes that show up it's looking at a 30-day average, so it's picking up when we make those debt service payments. This is when we pay the COPS payment. This is when we pay the TANs off, which is $115 million. So I kind of ignore those, but it is a spike. So we're working to reduce the cash in the bank. Although, I'm going to go back real quick. When you look at the rates we're earning from the bank, 2.4 is the earnings credit rate. That's the balance used to offset the bank fees. Excess balances are 2.28. That's not that far off from the securities that we have. And what's so when we talk about taking money out of the bank, it may work to keep the money in the bank. So we're going to be monitoring that very closely. But this is something we're going to show you from now on. Normally, I'm showing you projections, and we will add in, I have projections going out for the rest of the year. But this is just getting us through until tax revenues come in. I expect some of this cash will actually be investing. But it's a little early, and I'm not comfortable locking it in just yet. So this is the exact same information Jason went over earlier. These are all the securities that we have, and we've got them broken out by fund according to the system. So this is the core portfolio or the treasury pool. And then we have the small amount of money that's with TD Bank, and I know this is small. TD Bank is our custody bank, so when we have securities that mature, we pull cash down, but there may be a little bit left. So there's always a little bit left in that account. This is Bank of New York, so this is the debt service payments. This account has already gone back down to a much lower amount. But when we get to the short term, this is where I wanted to show you some of the mathematical gymnastics we went through to get the yield on the portfolio. When you look at bank balances, normally we would just list the amount of money in the account at the end of the month. But if you do that, it's not going to give you the right return because it's going to have the rate and the balance at the end of the month, not an average. So what we've had to do, and I wish that we could sort this a little bit differently, but the ones that have school after it, those three add up to the amount of money that's in the school bank accounts. But we have one line that is the amount that's earning interest, so there's $17 million that's earning interest. $5.5 million is used to offset the bank fees. And then I'm showing a negative amount with no rate on it. That negative amount is what we need to show the difference to get to the month-end cash position.
On the school accounts, who gets the benefit of the interest?
We're sending it to the schools now. For a while, the longest time, the amount needed to offset the bank balances, what they had in the bank wasn't enough to offset the bank fees. So the district was supplementing that. But as soon as it switched to the point where they had excess cash, we're now taking the interest earnings on those accounts and allocating it to the schools.
Now, do you allocate any expenses to the school to cover your additional overhead?
We're allocating only the point in excess of covering the bank fees. I'm not keeping anything for our costs because we want to give as much money back to the schools as we can. But we are holding back. So when you look at this, there's $5.5 million needed to offset their bank fees.
So obviously, you said before, you need more people to manage the school accounts. I mean,
so far we're managing it. And we met with the bookkeepers a week or two ago, and actually we made a presentation. I did a presentation at the state conference on school banking, and there's a lot of people trying to copy some of what we're doing here. And it's working really well. We are actually co-located in my office with we call it the FAST team, which is the team that works hand in hand with the bookkeepers. We're all in the same room together. So whenever there's an issue from the school, whether we hear about it first or they hear about it first, we're all working together to get that resolved. So there's a lot of synergy there. If we weren't all in the same room, I think it would be a lot harder to do what we do. But so far, it's working really well. Brenda is the main contact for the schools. She talks to them, I would hazard a guess, daily, and right now it's several times a day, trying to make sure they have cash for start of school. We have a new courier service that we're working through. So there's a lot going on, but there's 175 school accounts. So we have it set up so that the schools do not call the bank, they call us. We're their customer service desk. So we have online access to monitor their accounts. We're placing their stop payments. We're ordering change. We're ordering their checks and deposit slips. We have positive pay on those accounts now, so we manage that. So far, we've been able to do it with the resources that we have. So I just wanted to point out why why the negative number is there. It's just to get so that when we show the total amount in cash here, that is the amount that's really in the bank. So it looks awkward, and I wanted to make sure I went through that with you. I expect I'll spend a lot of time with the auditors on this year because it looks different. So we've broken out, of course, the TAN portfolio is all by itself, and now that really is the investments, but I wanted to come back and cover the sales tax as we always do. So far, we're currently at 114% of collections. This does not include the money earned in June, which we'll receive in August. So in August, the third payment in the quarter, we always get two. We get the regular payment plus the catch-up payment. So if you look at last quarter, it was negative for the first month, and then we eked out a little bit, and then the third quarter, we were way ahead of projection. The same thing's going to happen here. So it'll bump back to about 115%, maybe 116% of projections. So that's all working really well. Expenditures, we did see a pretty dramatic increase in June. We went from an average of $7 million of expenditures a month to $19 million in expenditures. Part of that is because we've also accrued expenditures. There's bills that we'd be paying in July, and we had to accrue it back to June. So for the members of the Sales Tax Committee that see this, when we include the July expenditures, which I hope to have that in, now, the next meeting will be August 30th. It'll still be just through this. But when they see July, the July expenditures most likely will be negative because we accrue the expenditures into June, and then we have a negative in July, and they offset each other. For accounting purposes, we have to show all the expenditures. And I had this discussion with our accounting director. The goal of this is really to show how much work has been done and how much expenditures should be on the books, even though we haven't necessarily paid all the bills yet. So those bills will be paid in July and August. But this is based on the work complete. Also, the amount of open purchase orders went up. It was 88 million in April, and it's up to 118 million. So we really are seeing an increase in spend. There's a lot of work going on at our schools right now. I don't know if you all see the videos that come out that the school that our communications put out. There's a tremendous amount of work happening in our schools this summer. And so I expect we're going to see some increase in expenditures, and then it will drop off because we focus the work when the kids are not in school. So we get as much done in the summer as we can, and then over the Thanksgiving break, the winter break, spring break, some work can be happening throughout the whole year, but we have to make sure we don't inconvenience the students. We don't want to impact their learning.
I mean, is that an anomaly in March where you see the huge variance? I mean,
no, I actually went back and looked. It was the period earned in January. So I think we went back when we created the forecast. We used prior year history, and I worked on this with Sherry Brown at Palm Beach County to sync everything up. And we used it in prior years. But ever since we went live with this, I remember the first sales tax payment we received that came in March of 2017. I was on the phone with the Department of Revenue because it was so far off our projections. So evidently, it's just the month of January, and what we receive in March is less than what our projection is. And it's happened in 2017, 2018, and 2019. At some point, I probably want to update these forecasts to where they are more realistic based on what we're seeing. But there's also something nice about showing the original forecast. I think with the last sales tax week.
And you're looking at March numbers getting paid in May. I mean, that's.
Well, it always is a 2-month delay.
No, I get that, but I mean, you got.
Well, it's higher. That one receives, that includes the catch-up payment. So there's very small entities that only have to submit sales tax quarterly. So they all come in that third one. So over the quarter, every quarter looks good once you get all 3 payments in. But you see the negative for the first one, and then it's about break even for the second, and then we have this big amount that comes in on the third payment. That's that quarterly. I refer to it as the catch-up payment, but it really is for small entities that only have to submit quarterly. Mm-hmm. So at some point, I'm probably going to add another forecast in. I think I did that with the last sales tax to say, here's our updated projection of what we think it to look like based on the last couple of years. So we don't see these big swings, but it's still working really well. Now, I've told everybody, don't get excited about the fact that we're way over. You could have a downturn in the economy, and that's absolutely something that everybody's looking at right now. You could see this slow down. So when we have money set, and ISOC sees this, the fact that we're above the interest earnings that we'll talk about, all those things are set aside. We're not letting anyone spend those because we may need them to backfill if we come in short later on. So expenditures, and I wanted to make sure I pointed this out. We actually have some more information here now. We have the revolving line of credit in place. We closed at the end of June. So what is authorized is up to $80 million. The maximum capacity is $200 million. What we've issued so far is the 80. We have not drawn down at all. We just have it in place. We did have some fees through June 30th, and that was really the cost of all the attorneys, the advisors, to get everything in place. We've made our first payment at this point. We pay a monthly fee. It's 0.1%. So I net all the expenditures out with the interest revenues to date are up to $5.2 million. So net is 5.1. We will not come close to spending even the interest earnings to date with the cost of this borrowing, assuming we don't actually draw down. If we start drawing down, if sales tax revenues slow down significantly and construction picks up and they start spending faster than we projected, we might actually need that line of credit. But my current projections showed that we would never actually draw down on it. We just need it to be able to issue the purchase orders to keep the projects going.
Leanne, I noticed out in Royal Palm Beach at the schools, they're putting fences up around all the schools, and it looks like it's a pretty good bit of money that they're putting out there.
Right. We had about $30 million set aside for school security within the sales tax. That was supposed to be spread apart $3 million a year with a 10-year window. We moved it all up. They have access to all that money right now. There's also a state grant. We received about $6 million to use. So there's a tremendous amount of money being spent on making sure the schools are safe.
Security,
Okay, the rest of this is just information. It is the information on the pools. I know that as we started putting more money in the pools, there was a concern, so we've just added this into our regular report. Florida Palm is the new name for FEITF, the Florida Education Investment Trust Fund. They changed the name to Florida Palm. As it started out just for schools, and really about half of the pool is now other local governments, cities, counties, special districts. So they've changed the name to be more reflective. Plus, it's easier to say. FEITF was just painful, and people tried to come up with what it meant. So Florida Palm sounds a lot better. It's easier, and it's better for the other entities to understand what it is. I still serve on the Investment Advisory Committee for that pool. And Mr. Shaw, our board member, serves as the chair of the board of the trustees. So this is the fact sheet for that pool, and I'm not going to spend any time on this. We certainly can, and at some point...
When I glanced at it at first, I thought it said fund fact sheet, and I was very disappointed to see the D.
We joked about that too, because on the first page of our sheet, I have fund fact sheets, and we joked that it's fund fact sheets. At some point, I've talked with Steve and a couple other people about maybe bringing the portfolio manager down that manages this pool. He works for PFM. So we're trying to coordinate the schedule for the finance committee to when he's planning to be in Florida anyways. So at some point, I don't know when that'll be, I'll actually bring him down so you can meet them. So there's information on that report. It also lists all the individual securities, and you have a hard copy of this in your package. I've reviewed it. I'm very comfortable with it. I don't want to spend a ton of time on it, but it's something that I promised you we would be monitoring, and we bring that information to you. So our report got a lot bigger because now we have over half the material in here is related to the pools. So once we get through that one, then you have Florida Prime, which is run by the state of Florida, actually managed by Federated. So they have similar information in theirs. They're much larger. It's $13.4 billion. So it's a very large fund, and their whole report is here as well. And we've looked at that just to make sure we're comfortable with what they're doing. There's some other pools out there that we've looked at possibly investing in. They seem to be doing a lot more on the corporate side and getting a little more risk in their portfolios. So right now I'm sticking with just those two. If we expand and start using others, we'll certainly let you know. Do you have any questions on the investment reports? Before our September meeting, I'm hoping to have the annual report done. This was just, our report was just finished yesterday. Accounting just got the interest allocation done yesterday. So this is really literally is hot off the presses. If there's any changes to this, and there could be as accounting goes through, if we have to revise this, I'll bring it back to you at the next meeting. But I think it's pretty close to that.
Leanne, I think one thing I wanted to point out on this page, I just realized that the top two are actually not annualized numbers. Those are quarterly, total returns. Okay. So we might want to think about the naming convention for that.
Okay. Well, and this is actually monthly return, so I agree. We probably need to look at this. We're keep trying to, and I ask the committee if you have any other information you want to see to please let me know, because we're trying to make some improvements to this report to make it more user-friendly, add the charts and graphs to make it a little easier to look at, but also make sure that we're providing all the information you need. So This hadn't had an overhaul in a very long time. So we're going to continue to make some improvements on it. And hopefully by next quarter, we've got the naming convention right. I actually brought that up. Laretha and I talked about that yesterday, and another way to do it, but the meeting was this morning.
Sure.
So we're going to let it go for today, but we're going to bring that back. This report actually gets included in the annual report that we'll be bringing back to you. So we'll make sure that we have this adjusted. We want to show the interest rates. It's just for information to show what all the different components of the short-term fund are. But I think we may need to rework this a little bit. Okay, so if there's no questions on that, then I'm going to go ahead and open up the market update and let Jason talk about the wild market.
Can I use the mouse for this one?
I think it works a little better. There you go.
Thank you. Okay, so I can make this as short or as long as you all wish. So if you've heard all this before, please stop me. But it has been an interesting few weeks. In the quarterly report, our market update is through June 30th. So we put together a few slides that are more current because obviously a lot has happened since June 30th.
Since yesterday.
So we had a few economic data points come in, saying last week this would be Monday through Friday, the July. So we had the PCE number here come in at 1.6%, so that was slightly below expectations. So that's personal consumption expenditures. That's what the Fed uses for their inflation measurement. They're looking for a 2% target. So inflation is still below where the Fed's looking for. Part of the reason why we saw a cut in interest rates last week and why we continue to think interest rates will be cut later in the year. Okay. These are kind of hard to read, so I'm just going to move forward to the good stuff here. So when we look at economic conditions, we're kind of seeing a mixed bag right now. We're still seeing GDP strong. You know, the Q1 number came in at 3.1%. Q2 came in at 2.1%. That was above expectations of about 1.8%. So growth is still strong. It's slowing down. Part of that due to corporate tax cuts not being renewed this year, as well as the trade war going on between the U.S. and China. Both of those are big hindrances on growth, right? But we're still seeing unemployment very positive at 3.7%. That's 50-year lows for unemployment. Wages are also going up with the unemployment, so the job picture is still quite strong. What we're seeing not as strong is the manufacturing index. So we're starting to see companies slow down on what they're producing. That's one of those negative signs that we're keeping a very close eye on, right? Consumer confidence still quite high. Everyone sees the elevated stock market. They see their 401ks at all-time highs. They see this 10-year market run is still going strong. So the average consumer is quite happy. And as I mentioned earlier, hourly earnings have been going in the right direction as well. But let's look at some of the negatives here. The Fed did cut interest rates 0.25 percentage points. Current Fed funds futures projections are showing 2, possibly even 3 more cuts at the end of the year, or by the end of the year, typically being 0.25% at a time. So we're seeing IMF growth projections revised down. So on the global economy, IMF projections down to 3.2% in 2019. Also revised down to 3.5% in 2020. You can see the U.S. is still doing well, but here's kind of the outlier here. You know, China is seeing revised growth down to 6.2%. You know, historically they've been in the 8 or 9% range. All right, so we also still have the trade policy uncertainty. U.S. and China have been going back and forth. Obviously, the last week and a half was quite evident of that with the stock market. We saw China let their currency fall to about 7 yuan per dollar. They did, we labeled them a currency manipulator, the Treasury did, and then they put a kind of a hold on their currency falling the following day, which is why you saw after that 900-point drop in the Dow last week, it did come back 250 points. So we're still down month to date, but still up quarter to date. Here's what I mentioned on inflation still being muted at 1.6%. The Fed's looking for 2%. So by reducing rates, they're hoping to boost that inflation number. Here's a graphical version of what the Fed funds futures market is looking like out through March of 2022. If we go back to March of 2017, you can see these gradual step-ups, 0.25% at a time, up to where we were before last week at 2.5 or 2.25 to 2.5. We see the cut here, and then we see at the end of December, the Fed was still projecting, or the futures market was still projecting one cut in 2019, and then one hike in 2019, and then maybe a cut or two going out later years. You can see as the year has progressed, in March that number went a little more south, and now here we are August 2nd, and we're down to 2, maybe 3 rate cuts by the end of the year. So obviously that's going to have a direct impact on the short-term portfolios and the interest earnings in the portfolios. We talked about tariffs earlier. Those are going into effect, an additional $300 billion on Chinese imports. You can see one interesting thing to point out when we talk about who's going to give in first, per se. Is it going to be China who gives in, or is it the U.S.? They export 4 times more goods to us than we export to them. So they have more to lose in this battle. But with the currency manipulation they've been doing, that's kind of an indicator to me that they're in it for the long haul, right? They know that if President Trump wants a chance of re-election, he's got to have a strong economy in 2020. So are they in this for the long haul and going to let this drag out and maybe hope the U.S. gives in first? Or will they see that their economy is slowing down too quickly and they don't have the ability to ease it, and maybe they will give in first? So the rest of the year is going to be something very closely watched, not only with China and U.S., but also we have Brexit coming up in October, right? And so they have a decision to make, and the market hates uncertainty, so if they don't get it resolved right up until the deadline, you could still see some more bounces in the global economy come October. Here's a look at where yields have gone. So we have the 1-week change in yield up top, and then we have the year-to-date change on the bottom. So you can see, 2, 3, 5, and 7-year yields almost down 1 percentage point year-to-date. A lot of that has to do with the uncertain future, right? As people become more skeptical, they put their money in safe haven assets such as treasuries. That drives the market value up, which in turn reduces the yield. Sorry about that. Just a different way to look at the 2-year yield. We can see we almost touched 3% in November, and now we're all the way down to 160 on the 2-year, and then the 10 years on the next slide here at 176. Here's the inverted curve that we talked about. You can see this is as of August 5th here, this dark blue line on the bottom. 3-month Treasury yields were paying 2%. It dips all the way down to 156 or so here on the 5-year, and then starts to go back up. You can see where we were just a year ago. We still had a normal looking yield curve with the 3-month at 2%, 10-year closer to 3%. As the Fed reduces rates, we expect this to come down, but if folks are still piling money into these longer term treasuries, this farther out end is going to come down as well. Good news for falling interest rates is on a total return basis, the different asset classes do quite well. So if you look at returns year to date for the 1 to 3 year indice, you can see treasuries, agencies, and corporates all showing very, very strong returns on a year-to-date basis, and then quarter-to-date down here at the bottom. And obviously, the longer out you go with falling interest rates, the better returns you have. So 1 to 5 year indice is just graphed here on the right. So despite the big dip we had in the equity markets, we're still up 17% year-to-date at the S&P. So stocks have still done quite well. You may remember the Christmas Eve sell-off from last year. So we've recovered quite a bit since then. I haven't checked yet today, but I know the market was up yesterday, so we'll see where we are once the market opens this morning. Okay. This is just upcoming indicators that we kind of look at internally, so nothing really to discuss here. These have all come in this week, but we talk about each of these on a Monday morning internally, so we'll see what the numbers say Monday when we talk about these. So that's what I have for current market update. I'm happy to go back and discuss the second quarter market update if anyone's interested, but Leanne and I thought the most current stuff would be more topical for today.
And one of the things that we have in our queue is a COPS issue, so a long-term debt issue, and I've already reached out to the facilities department. I want to try to get that done sooner rather than later. Try to take advantage of the lower rates. And there's a lot of uncertainty in the bond market right now, a lot more than in the stock market, obviously. So I want to make sure we get that going as quickly as we can. So I'd like to bring it to you in September. If we can, we will. Otherwise, it would come at the next meeting, which would be, I think, in October. I think we have another one in October and then December. So you can expect to see a COPS issue coming across your desk very soon. Okay. I don't have any other topics for the agenda. I do want to point out that the next meeting is scheduled, and it's on the back of your agenda, all the future dates. The next one is September 24th, and we'll have the annual reports. We will have to do elections of officers at that meeting. Hopefully, we'll have the new money COPS issue. And following that meeting, we will have all the students come in, and we do the TAN sale that day. So we'll see what kind of rate we get with that as we do that, and I know the kids are looking forward to it. You all are always welcome to stay. We try to get as many of the investment bankers and advisors to come to that as possible to help participate. It's always a lot of fun. So that's the next meeting. It's a Tuesday, not Friday. So that's the one day of the year where we have an odd day. So it's Tuesday, September 24th. Make sure I say thank you to all of you for coming today.
There being no further business, the meeting is adjourned.
Thank you.